Hello, fellow traders. Hello, fellow futures traders. My name is Curtis White from Beyond Backtesting. Today, I'm going to be talking about what I think of one of the keys to great trading, and but even more importantly, to not losing large amounts of money. And it's going to deal with self-regulation. We're going to get to that. First, I want to talk about a little bit about the background. I've wanted to put something in the background to have something visually just a bit more appealing. And what you're looking at in the background is the FuturesPlus platform offered through Tradestation. This is a TT's platform. This is a separate futures account, separate from Tradestation Desktop. Now, this is a very nice platform. It has a very nice DOM and it has a nice chart trader. It's TT's platform, right? But unless and we're talking about why you may want to use it, but unless you specifically need it, I haven't seen anything that can you can't get in other retail platforms or NinjaTrader. I have an AMP account, and why is that important? Is because probably this is the trade fees are probably too high to justify, at least trading it as through TradeStation's offering, because my trade fees on this platform are double my AMP fees, so it really hard to justify it. Now I have it for a couple of reasons, and I was going to do futures options trading at one time. I haven't really did any of that or much of that to amount to anything. And that's one reason I haven't. And you can't do futures options through TradeStation Desktop. This also supports futures spreads. So if you're going to do futures spreads or futures options, this would be a great platform to look at. If not, you can probably it's still a great platform, but the trade fees are probably too high to justify. Let me know though if you can get this through AMP on an AMP account, and I may take a look at it through AMP. Again, I can find most of these functionalities through NinjaTrader or NinjaTrader add-ons and things. So I don't know that I would use it if it was even available, but it is very nice, and it's a nice platform. But the trade fees are probably just too high to justify unless you're doing futures options or futures spreads. The TradeStation Desktop platform has better cost structure, but not as good as the AMP. So it depends on what you're trying to do. But the other interesting part with this is you cannot execute TradeStation desktop trades through this platform, through this account. So you need a separate account, completely separate for this. So it's nice. It's very nice, and I don't know how many people know about it. So I haven't looked to see if I can get through AMP, but it might be a nice platform to try. If I could get through AMP at a reasonable trade cost for my per contract, but just as it is, it's just I don't see a point in it. So that's that on the trade. Let's get back to the topic though. So we're talking about the keys to great trading and not losing large amounts of money, and this is the key: the ability to self-regulate oneself in relation to market opportunity is, I think, what the key that really summarizes in one sentence the key to great trading, but also, just as importantly, not losing large amounts of money. And I'll say that again: the ability to self-regulate oneself or yourself in relation to market opportunity. It's not enough to be able to regulate yourself or self-regulate oneself. It's not enough to identify market opportunity. It's a combination of how one is able to regulate oneself in relation to that market opportunity that really defines great trading. And this is something, again, some of the lessons I've learned over the last year to 2 years, but even goes further back. And when I think of in the past where I was able to call markets very well, and sometimes I would see a trader, a professional, and I could see the trader could not read the market, could not understand the market activity as well as I could, but they were able to trade better because they were able to self-regulate themselves in relation to their limitations, right? In relation to their ability, better than I could in relation to my ability, and so it's not one thing. If you were to look at, say, okay, just your ability to call markets, right? I would probably, there's very few people I've seen who could call markets as well as I can, but that's just a small part of trading. And it's maybe half or less of the totality of skills needed to trade successfully. So if you just look at one aspect, you're missing the big picture, right? You're missing the big picture of what it means to be able to trade. And people talk about discipline. Well, this is discipline. This encompasses discipline, but it goes to a higher level. When we talk about great trading, right? It's more than just discipline. It's the ability to self-regulate oneself at a higher level, and we'll talk about some of the different ways and how do we achieve this. And so, one thing, in order to do this, one has to crystallize in their mind the discipline. And the best way to do this is to see a trader who trades discipline and is able to be successful. And without the ability to see a successful trader, or without seeing discipline, it's very hard to crystallize it. But crystallizing it, seeing it, is not enough to. It's not enough to say that you will be able to do it, right? It just means that you know what it means. And this is many things in trading is knowing it doesn't automatically lead to success, but if you can at least understand it, then you can work toward it, right? And you can understand how closely you're adhering to that. So that would be one thing I would say is you need to have it crystallized in your mind what that discipline means, and then you can work toward it, right? But there are some. And what are some of the things we can do to better self-regulate ourselves in relation to market opportunity, right? And some traders, and there's absolutely nothing wrong with this, have determined the best way they can regulate themselves is to completely take themselves out of the decision making, real-time decision making, and just monitor systems and develop systems, and that's perfectly viable. In fact, I would say most professionals are trading quantitative because of the amount of money they manage. They're trading in a systematic fashion, and that's a very professional way to trade. And I've thought many times, and even still consider, maybe going fully automated. And I do want to build more automated strategies and do more of that. And it's perfectly valid to say, look, I can't regulate myself, or I can't identify market. You see, we're talking about two different things here. So you can have all the discipline in the world, but if you can't identify market opportunity, valid market opportunity, then that's not going to help you. If you can't regulate yourself, but you can identify market opportunity, that's not going to work either. If you can do both, but not at the same time, that's not going to work either. So trading is very difficult. So how we achieve this, there's different ways of achieving this, right? And automated trading, maybe this is how you determine that you achieve this. But if we're talking about a partially discretionary method or a gray box process or anything where there's any element of discretion, right? You're going to have to be able to do this, right? And so how do we achieve this? How do we do this, right? Well, one thing we can do is just recognize the market is random, okay? And maybe random is not the proper term. Maybe it's chaotic. I think that's probably a better term. But recognize that even if we have the best trade, we can lose on it. We can lose on it again. We can lose on it again. And therefore, what does that mean? We have to be prepared mentally for whatever size, whatever loss we're trading, however we're trading, right? And also financially. If you're prepared mentally but not financially, then you still can't continue to trade if you have too many losses, right? So the ability to prepare ourselves in both aspects is required. It's not enough to be mentally strong and say, look, I'm going to go in there and trade this way with a small account because you're probably going to blow it out, and then you're not going to be able to continue trading, right? It's not enough to be able to be financially, if you're going to quit, if you're not truly going to utilize that financially. I've seen that many times too, and that's maybe often probably the right thing. But traders will say, okay, I have X amount of money to trade. They'll say, and then they lose the small tiniest portion of that of what they said they had to trade, and they're out, they're done. So we have to be able to do both, right? And then, okay, from that, what does that infer, right? Just that recognition that, and I would say it's worse than random. Market's predictable enough to entice trade, right? That's what the market's job is, to entice trade. So it's going to be predictable enough for there to be profit opportunity, and if it's truly just completely random, right, then nobody would trade. And so it's dynamically random, right? Let's just say that it's dynamically random, and then so it causes people to lose money, right? Because of just the nature of it. Once we understand the nature of the market, then we can understand a couple things. we don't, discipline and risk management, all that is nice, but how do we do that? How do we achieve discipline and risk management? One of the best things is to be able to understand the risk, right? Be able to understand it, right? How much are we risking on a trade, and how much could it move against us? But very important, and I think really key is don't don't put yourself at risk. Don't put yourself at great risk, right? And that means not loading up on trades, okay? And this is difficult for me because there was a time when I really felt that I could do that successfully, and over time I learned it backfired. And so when we think about risk, right? In the futures market, if the market doesn't move much against you, you can have on a large size and not necessarily large risk. If you take it off, right? But unless you've demonstrated you can do that, and in a very consistent way, and unless you have, so here's the thing: if you have on a large position and the market moves too quickly against you for you to take it off, whose fault is that? It's basically your fault, right? The market didn't, in any trade, everybody can see what's happening. Everybody's can see what's happening. Everybody can trade it, but you'd probably find very different results from different traders because of how they manage the risk, how they regulate themselves, and when you load up on a trade, you're most likely succumbing to a fallacy that you can the risk-free illusion. This idea that you can get in a trade and not taking a risk and that it's just going to work, and if the market moves too fast, or you don't have your stop in or whatever it is, and you have a big loss, that is exacerbated by putting on larger size. So we talk about risk, where there's dollar risk, right? And that's very important. But there's also size risk, right? There's at a certain size, even if the dollar risk is, you say, okay, you may be in trouble. You can also, we'll continue on here. I don't want to talk too much about that, but that was one of the things. You can regulate your pace of trading, right? When you trade more frequently, it's going to be more difficult to regulate yourself. Very likely. Now, there's a concept of the dominant frequency in the market, or frequencies in the market, and the ability to recognize patterns and things. So it's going to be a frequency that's going to maybe work best for yourself, and that could be more frequent trading than what other people might feel like. But you're still, whether you're trading whatever frequency you're trading at, you're regulating that. There's a regulation of that. It's not ad hoc. It's not it's not out of control, right? You can regulate the times that you trade, and again how much you trade, and stopping when you're up on the day, right? And or stopping when you start to lose. Okay, so again, this is at a different level, right? Is you're regulating your energies, and say, okay, I'm not going to still trade 24/7 because it's going to cause me to become exhausted, and then I'm not going to be able to trade as well. We can talk about regulating your emotions, right? And in terms of that, in terms of not getting into trades just for activity's sake, in terms of also introspecting and being aware of good instincts to get out of a trade. So all these are all the skills, right? But some of these are more toward the trading great, and some of these are more toward not losing large amounts. And in the discipline, the risk management, the size management will go a long ways toward regulating towards not losing large amounts, right? And that is a key. but yes, if you can, you may not be the best trader, but if you can regulate yourself, right? In other words, if you can regulate yourself better, then you can actually trade better than someone who's a better trader. And I think it's something I've seen, and so they're both together, right? If you're have they go both together, right? So that you have to trade and find where your edge is, and then stay out of the bad trades, right? Now, the other aspect of this is, I think, in generally in terms of taking a more professional approach to trading, is, and this is something I made a mistake in the past, is either I've been very serious about trading and I'm risking a lot of money, or I've been at times, and not so much this past year, but in the past, at times I was like, I'm not going to risk much. I'm just going to get in here and play around, and that almost never works well because of a couple of reasons. One is it's not purposeful. Okay, what's about purpose? Okay, purposeful trading. It's not developing anything, and I could actually be developing bad habits by doing that. But it also, when we put ourselves at risk, even if we are not risking a lot, it's still money, and markets are still can do some crazy things. And some of those times, especially again, if we're not regulating ourselves, if we're not awake, and we're just in there just trading, there's a very high chance of discipline lapse, and therefore there's a risk we're going to put ourselves at risk. So being purposeful in our trading I think goes to this whole lesson of self-regulation. But being purposeful does not mean that we have to risk like a professional trader, right? And this is where I think I'm at today, is that I don't need to risk to prove that that what I'm doing is meaningful in my trading, because I can trade, I can fund, and until I've developed a method, right? I'm okay taking very small trades, trading in the simulator, whatever I need to do to advance my trading is more important than trying to make $500 in a day per se, right? If I'm not able to do that, and this goes back to some of the self-regulations part, but also just accepting the risk, right, in advance, and understanding, on a position trade, the risk dynamics I'm going to take and I'm comfortable with are much different than in a day trade, right? And where I'm at in my day trading, I might be where $100 risk is where I need to be at. Where on a position trade, it might be much different. Okay, but whatever risk it is, whether it's thousands of dollars or $100 or $50, we need to be accept that, and then and being purposeful. You don't have to trade big size to trade in a professional way, right? You don't have to trade. One of the things I did the last year, we did a lot of tryouts, and until I realized that the biggest reason I stopped the tryouts was because the funded trader fees, you lose 50% of the account in a year or 6 months just for the trader fees. But also when I did the math, I said, okay, you can't. There's no benefit to you can't achieve a result unless you can sustain your trading and build on it over some period of time. So no matter how well you can trade, unless you can build on it, it's not going to amount to anything, right? It's not going to grow. And if you can build, if you can trade consistently, if you can grow it, if you can advance what you're doing, then I found that a $7,000 futures account would be, starting a $7,000 futures account or a $25,000 trial account, within 12 to 18 months, you're at the same place. It was around $220,000 you'd be making in that period of time. You actually did better with just a $7,000 of futures account, assuming you don't scale up to making, assuming you put a cap on how much you're scaling it to to where you say you're only trying to make something like 2,000 a day, or something of that nature, which many traders are going to. There's a certain point where it just doesn't make sense to keep trying to scale your trading because you're making enough, and because of the markets can change and the randomness and the potential for loss. In that scenario, within 12 to 18 months, you're at the same place. So, getting an account or doing well over a short period of time is never going to lead to the type of income that trading well over time can. If you can trade well over time, then you can grow your account organically, right? That's and then also flexibility of approach. So I've talked about systematic trading, I've talked about algorithmic trading, I've talked about some discretionary trading, I've talked about day trading, swing trading, and I think if we think about a more professional way, a more successful way of trading, one is open to different ways of trading and open to potentially changing their trading based on how things are working. So I don't necessarily have to pursue day trading to be a trader, although I am still willing to do that in some context. It's just I can also pursue that through systematic trading, algorithmic trading. Being able to be flexible and in one's approach is, I think, a sign of maturity in one's trading, and may lead to more viable outcomes. Finally, in terms of the more professional type of trading, or I would call it keys to great trading or successful trading. And this is probably the most difficult one, is adversity and the ability to overcome adversity. And this is one where one of the reasons I talked about not loading up on trading, or the ability not to that I had to step back from loading up, and we talked about the discipline aspect, is that there's no win in trading. And this is, I think, an important realization, right? There's no win. Meaning that if you load up, if you truly want to trade, most of us don't want to trade. We say we want to trade for a living, but most of us really want to trade for life. Most serious traders want to trade for life. They say trade for a living, but most of us want to trade for life, right? And if I load up on a given trade or a given day and I make a lot of money, I don't win unless I stop, right? If you go back and you trade the next week, the next day, even the next month, you're still back in the game. You can still lose, and you've hurt your discipline. You've hurt your credibility to yourself by doing that, and so there's no win. I think that's it's humbling when we think about trading. Is there's no win in this game, in the sense that the only way we can determine if you were a winner is if you stop when you're up and you quit. So if you're an active trader, you haven't won. You're in the game. You're still in the game. Only people who have retired trading or have quit trading can be said to be a winner. Otherwise, it's a open question as to whether or not you will be a winner, right? Because you could give back. So this adversity question is an open question too, and there's not an answer, because just like any business, any endeavor, there's always a point where people say, okay, I've had enough of this business. I've had enough trying to do this. And they say, I'm going to go on to something else. And so do I have the capability to overcome adversity to some degree? But do I have it enough to be successful? Maybe to some degree, maybe not. It's an open-ended question. And it's something we all have to ask ourselves, right? Throughout as we trade. And traders, I've stepped back from trading many times for months, and then come back to it, and I think that's fine, right? The reality of trading is that you could be trading a system or portfolio systems. Recently, I was looking at one of the portfolios of another trader's YouTube channel who I monitor, and they're having their worst drawdown. If I looked at it correctly. At what point do you determine, okay, this is the worst drawdown. This isn't working. Or from this is an opportunity to get into a system when it's in a drawdown, to this is not working. This is broken, right? Or to where it's not worth it to me to do this. And that's something we have to it's something I think that characterizes the great traders, and it's not. This is probably the hardest thing to capture through any type of skills development because it goes beyond that. But what we can capture, right? And this is, I don't think you can necessarily train that or capture that in any meaningful way. Maybe there is, I don't know, but what we can capture is what we can control, and that is our size and our risk as well as we can. Within the context of our ability and within the trading we're doing. So, yes, you can't control your risk, especially if you're holding positions and you're doing position trading, but you can control your trade size, which can, largely control your risk, right? We can do what we can, and then some things will happen. There are always going to be mistakes and things that happen, but to any extent that we can, we need to the ability to control ourselves and our risk and regulate that it's what enables us to trade better. So I hope this helps.